We will present our Orange Tracks Session 3, what you need to know about product-led growth, with our presenter, Ed Arnold. Ed, welcome. Take it away.
Thank you, Chuck. And hello, everyone. Yes, this is Ed Arnold, and I'm here to tell you about product-led growth. It's really exciting to be presenting here today at the online Product Camp conference with, especially with people from all over the world chiming in. And I want to give a special shout out to all of my Boston area colleagues, members of the Boston Product Management Association. It's great to see so many of us in the conference today. All right, so to get started, 3 topics. First, what is product-led growth? Then secondly, why has it suddenly become so popular? You see it a lot mentioned nowadays. And then lastly, and probably most important, what can any business learn about PLG? And so to get started, I'm going to sort of set a scene. Let's say, you're at your workspace having a typical day like this, managing your product, and then out of the blue, you get a message come in from one of your executive team members. Could be email, it could be Slack, however it comes in, to the effect of, hey, the board wants to know about our product-led growth strategy. So can you please send me your PLG slides or deck ASAP? I don't know how you would react to that, but I think I know how I would. I would have kind of what I would refer to as a big Lebowski moment. And if you're a fan of the movie, you'll know where this is going. And with apologies to any Knutsons out there, I'm going to paraphrase one of the dude's many memorable quotes from that movie, which is, what the blank is product-led growth? That's what I do. I'm a product manager. I'm all about growing my product. And I've communicated my strategy, and you've seen it. So what exactly do you mean by product-led growth? Well, to answer that question, I'm going to quote the person who coined the term product-led growth. His name is Blake Bartlett. He's from OpenView Partners, which is a VC firm here in the Boston area. And he says that it's an end-user focused growth model that relies on the product itself as the primary driver of customer acquisition, conversion, and expansion. And by the way, I'll say that I'm a big fan of OpenView's blog. They have a great repository of information on PLG, SaaS strategy in general, startups. It's a great source of information. And a lot of it is written by another partner there named Kyle Poyer, who I would recommend following, because to me, Kyle is the dude when it comes to PLG. But I've spent a lot of time looking at that content over the last 6 months, as well as from other VCs and other sources. And when you do a deep dive into that content, you get some what I call attributes or characteristics of product-led growth companies. And so to summarize, first of all, they are pure play SaaS products, primarily going after B2B markets. Second, the end user is the buyer. So it's a purely bottoms up sales motion. There are no other budget holders or stakeholders to sell to. They are low priced. In fact, many starting at a freemium or at least a free trial, and then low price points, which inevitably gives you a low average contract value or ACV. How low? Well, according to Blossom Street Ventures, companies like Slack, Atlassian, Twilio average about $4,000 to $6,000 per year in ACV. HubSpot, which is often an example of a product-led growth company, is a little higher, about $8,000 a year. If you look at companies like SurveyMonkey and Dropbox, it's well under $1,000 a year in ACV. So at these prices, this is a no-touch self-service model. That means there are no humans in the sales process or in the customer success. It's entirely self-service. And lastly, the focus is very heavily in R&D and product development. On average, these companies spend 1.5 to 2x more on their R&D than they do in sales and marketing expenses. So those are the main characteristics. And if you work in a company that checks all these boxes, I say, congratulations, you're in a great place. But for the rest of us, especially folks who manage maybe SaaS products with services or hardware or data, or who have higher price points or have dedicated sales and services team, fair to say that this gets a little bit more complicated. And so where I want to go next is to talk about why this is a thing. Why has PLG suddenly become so popular? Because for me, having been around and seen business trends come and go over the last few years, answering that can help us get a better understanding of how this thing works and how we can adapt that to our own situation. And, you know, one possible explanation for why you're getting that message from the executive team is what I would call the bandwagon effect. You know, and the leaders of this band obviously are the VCs. And why they're doing that is because, well, they've been successful at it. They have profited by the fast growth and returns on their investments on these companies, and the list is growing every year. If you look at the names here, these are products that we use every day. In fact, we're using one right now. We're using Zoom, but folks use Slack, and they use HubSpot and Zendesk and LogMeIn. You know, these companies continue to grow. They continue to be very, very successful. In 2020, even during the pandemic, they were growing on average of a little bit less than 30% revenue growth per year, which is fantastic. And when you think about a company like Zoom, the pandemic has been an accelerator. They grew 10 times that, phenomenal growth. And so the investors are, you know, they're really celebrating. We have a herd of unicorns here that with great valuations because of having the right solution in the right place at the right time. And PLG companies have valuations on average of about 20x revenue. You know, a good services company is lucky to get 2 or 3x revenue. So 20x really solves the mystery about why this is a thing, because these valuations are outstanding. So maybe the real question is, well, why are these PLG companies growing so fast? Because that's really why the valuations are occurring. And to answer that question, you know, we can answer that question really with 3 simple words: economies of scale. If you recall your college economics course, you learned about, you know, the larger firms have average cost, the low cost provider. Average costs go down because of volume, and volume is driven by low price. It's a classic model. We've all seen it before. And so at the risk of dating myself, this does remind me a little bit about the early days of the fast food business. Think back, if you can remember historically, for some, McDonald's in the early days was advertising millions of hamburgers sold, and we're selling them at 15 cents. Well, what was happening? Well, they invested a lot of money to scale this model. They invested in equipment. They invested in the food supply chain. They invested in advertising. And that's what grew this model and lowered those costs. And it's the same thing with PLG companies today, investing in R&D. They are investing in the software talent, which is why it's hard to get good software engineers. They're also investing in marketing automation to keep the customer acquisition costs low. So it's nothing new. It's basically the use of a time-tested strategy. And so, the makes you wonder a little bit about, where the future holds, right? As the markets mature and competition increases, we know that, McDonald's has evolved quite a bit since the day of the 15-cent hamburgers. And one indication of where this may be going, if we think about where the PLG stars of today are going to be in 5 or 10 years, I just saw this last week in this New York Times tech column, which I follow, and they were talking about valuations of these companies actually starting to drop and flatten out. And Dropbox, which is one of the PLG companies on our list, was one of them. It could be a symbol or a sign of the shapes of things to come, but time will tell whether these growth rates and valuations are sustainable or not. I think an interesting other resource that gets at what a lot of these companies are engaging in is what happens when they grow to a certain point and they have to focus more on enterprise. And so there's some great content from a VC company called Andreessen Horowitz. They talk about what they call this growth plus sales shift. That is, when does these companies need to add a top-down sales model to complement their bottom-up organic end-user growth? And on the left is a decision tree about that. And on the right, they show when companies have added that at particular sizes in ARR. Interesting that Dropbox is one of those companies there. But what's happening is that, ACVs obviously rise as you build out into the enterprise, but that's going to require dedicated sales resources as well as dedicated customer success sources or services to support that. Because having worked with B2B enterprise clients, self-serve isn't enough. They're going to want some hand-holding, and it's a balancing act between those rising costs and growing out those accounts. Now, that's what this content's about. But to me, what's most sobering is that, they would say that, well, this is a challenge, but for traditional companies that already have a top-down model, they're at a severe disadvantage versus PLG companies. That, if they don't have that bottom-up sales volume, you're going to lose. And so that's a very sobering thought for folks who aren't a pure play PLG company. So is there any hope there? Well, yeah, I think there is. And I think there's a lot of things we can learn from product-led growth best practices. And of course, the advantage of product-led growth is because of the big focus they have on the product. So the product is basically, it's like it's a dog with one tail in a sense. It's just one tail to focus on. But we know that in our businesses, in many businesses, we have more than one tail. We have a SaaS product with services or hardware or data, and it gets a little bit harder. And 2020 in particular was probably a tough year, right? I know a lot of companies did not get that 30% growth rate like PLG companies did, at least amongst product managers that I keep in touch with. And I was looking for data on this and really couldn't find much about what the other half was doing. So my colleagues at Ibuka Market hosted a survey on digital product growth. I'm really happy to share some of those results here for the very first time. First of all, what we found was, well, no surprise, many of these companies did not match that 30% average. Some did, but the majority of them didn't. Over 60% didn't. And on top of that, most of them, or a good number of them, I would say about 40%, did not meet their revenue growth expectations for 2020. They were, below their expectations. And the reason for that, most common reason cited, was because of the pandemic as having a serious headwind on their business. We asked them then, what are you going to do about this in 2021? And you'll see there, in terms of investments of time and money, you see the results are all over the map, all across the enterprise, whether we're talking about sales, marketing, products, partnerships, services, etc. Trying to improve on the results for 2020. That may make sense, but then again, where we started from was, well, what's our product-led growth? In other words, is there anything from the product-led growth playbook that companies that are not pure play product-led growth companies can use and benefit from? And I think the answer to that is, yeah, there are. I'll quote OpenView again, where they provide a number of best practices. I'll talk about a few of these, but one point I'll make is that it's not an all or nothing situation. In fact, trying to be a product-led growth company, especially if you're not have those attributes, as I said, it may be impossible or unwise to even try. But there are things that you can do to get some of that benefit from it. The first thing is that having a free trial offer, which most PLG companies have. There's the best way to prove the value of your product is to let people try it out for a test drive, but you have to think about how you're going to do that. I know companies that basically turn the keys over with no support and let people try to figure it out for themselves. That doesn't work. What you have to think about is pulling out a piece of that product, something that can address low-hanging fruit, a quick win, something that can be quickly learned and utilized. That type of free trial will certainly help. Secondly, you have to think about your approach of onboarding, right? You have to remove the human touches in that process. So maybe you don't need to have live training classes when a series of short videos could certainly get people up and started without having to schedule. A third one is that product-led growth companies pay very close attention to their product analytics. They are looking at daily active use and making decisions based on what the end users are doing day in and day out. It astounds me. I've seen some SaaS product teams who pay very little attention to usage. You have to be looking at this. I mean, at least on a monthly basis, if not weekly or even daily, depending on the case. But that is basically the insight that you need about whether end users are getting any value from your product, taking a close look at that. And then finally, looking at the buying experience and making that self-service. So instead of having a click here to schedule a demo, you can replace that with a click here to watch a demo, or even better, click here to start using the product. Now, for me, I think my biggest takeaway about product-led growth is that it reminds and compels us to put the end user first. And I think, instinctively product managers understand that, but we get sidetracked, right? We get sidetracked by a lot of competing priorities. I think what this does is it gives us permission to push back on other demands on our time and focus on the end user. And if there's anything that remember, if there's anything that you would like to that I'd like you to remember from this talk, there are two phrases. One is instant gratification, and the other is remove friction everywhere. Instant gratification means that your end user needs to get an aha moment very early in the product use. And that can be a very tough thing, especially with B2B products. At a minimum, you need to be able to remove anything that's irritating customers or end users that are using it. Because that's really the key to getting growth is to make that as useful and valuable as quickly as possible. The second is removing friction everywhere. That's from the very first touch when customers check out your product, throughout the buying process, throughout everywhere. That means you have to make that experience as seamless as possible. Seek and destroy anything that can get in the way of their progress. And in order to do that, you really need to understand what those end users are. You really need to map out their customer journey, their entire journey from the buying process through the customer journey. That means doing a lot of listening, voice of the customer, user groups, conferences, you name it, and also watching the metrics. As a product manager, you need to be the single source of truth about what's going on with the end users, because you're going to need that to persuade internal stakeholders, external stakeholders about the direction and the growth for your product, and to counter those anecdotal, hey, how about this? How about that? You need to base that on data, because ultimately what you're going to need to do is make a business case about more R&D investment. And so that's the type of thing that would go back into that deck to that senior executive who asked you about what our product-led growth strategy ought to be. Is this is what we need to spend, because this is what product-led growth companies do, and this is how we're going to spend it, and this is what it's going to get us. So those are my main points here. I leave you in this presentation with some resources that I've referenced in a few more. And lastly, to say thank you very much for your kind attention.
Thank you again, Ed Arnold.